legacy structural challenges, as well as heightened exchange rate pressures driven by rising capital flow reversals, in addition to the outlined shocks from the global economy. In the financial markets, available data suggests that investors are now rebalancing their portfolios away from gold and equities to fixed income securities to take advantage of rising yields in the advanced economies as major central banks progress with interest rate liftoff. Consequently, the tightening of global financial conditions is expected to heighten investment and debt default risks, leading to likelihood of a broad economic slowdown. Domestic economic development. According to the National Bureau of Statistics, NBS, real gross domestic product GDP grew by 3.11% year-on-year in the first quarter of 2022, compared with 3.98% in the fourth quarter of 2021 and 0.51% in the corresponding period of 2021. The economy has thus grown for 6 consecutive quarters following its exit from recession in 2020. This consistent positive performance was driven largely by the continuous growth in the non-oil sector, specifically in the services and agriculture subsectors, ongoing policy support post-COVID lockdowns, and the base effect from the corresponding period. Star projections show that the economy is expected to remain on a path of sustained positive growth observed in the last few quarters. The committee also noted that both the manufacturing and non-manufacturing purchasing managers indices increased above the 50 index point benchmark to 51.1 and 50.3 index points in June 2022, compared with 48.9 and 49.9 index points respectively in May 2022. This reflects the continued rebound in economic activities due to improvements in supplier delivery times, raw materials inventory, and employment levels, as well as expansion in some sectors such as agriculture, accommodation, electricity, among others. The committee noted with concern the persistent uptick in headline inflation year-on-year to 18.6% in June 2022 from 17.71% in May 2022, an 89 basis points increase in just a month. This continued increase in inflation was driven by increases in both the core and the food components to 15.75 and 20.6% in June 2022. This considerable rise in core inflation resulted largely from the rising cost of production due to high energy prices associated with the persistent disruptions to power supply, hike in electricity tariff, continued scarcity of petroleum motor spirit PMS, and rising price of automatic gas oil AGO. The increase in the food component was, however, driven by shocks to food prices associated with continued insecurity in food producing areas and along major access routes across the country, the continued impact of the war in Ukraine on the supply of fertilizer inputs, wheat and other grains, exchange rate pressures, and the impact of monetary policy normalization on capital flows away from emerging markets. The committee, however, expressed confidence in the bank's sustained intervention programs, noting that inflation is expected to abate as food supply improves and the fiscal authorities sustain its efforts to tame the legacy structural challenges which put upward pressure on domestic price levels. Members therefore urge the fiscal authority to expand and sustain its support for all this recently deployed stimulus to the real sector of our economy. The Monetary Policy Committee noted that broad money supply M3 rose significantly to 11.52% in June 2022, compared with 10.86% in May 2022. This was largely driven by the growth in net domestic assets NDA of 18.02% in June 2022, compared with 17.37% in the previous month. The sustained growth in net domestic assets was attributed to the increase in claims on the federal government and other sectors, in this case public, non-financial corporations, private sector, and state and local governments. Money market rates oscillated above and below the asymmetric corridor, reflecting prevailing liquidity conditions in the banking system. Consequently, the monthly weighted average open buyback rate OBB and interbank call rates increased in June 2022 to 10.89 and 11.1% from 9.39 and 8.38% in May 20 respectively. The increase in both the open buyback and interbank call rates reflected the tight liquidity conditions in the banking system. Capital adequacy ratio and the liquidity ratios both remained above the prudential limits of 14.1 and 42.6% respectively in June 2022. Committee, however, noted with concern the slight uptick in non-performing loans ratio of 5% in June 2022 compared with 5.7% in June 2021. The MPC thus urged the bank to sustain its tight prudential regime to ensure that NPL ratio is brought well below its prudential benchmark. MPC noted the very moderate decline in the performance of the equities market in the review period, as the all-share index and the market capitalization moderated to 51,817.59 and 27.94 trillion naira on June 30, 2022, from 52,990.78 and 28.56 trillion naira on May 31, 2022, respectively. The market, however, remains resilient, reflecting continued confidence in the Nigerian economy as both the monetary and fiscal authorities work assiduously to improve macroeconomic fundamentals in Nigeria. Committee noted the marginal increase of 1.61% in the level of external reserves to $39.22 billion at the end of June 2022 from $38.360 billion at the end of May 2022 due to increase in flows from non-oil sources. The committee reviewed the performance of the bank's intervention programs targeted at stimulating productivity in agriculture, manufacturing industries, energy and infrastructure, healthcare, exports, and micro, small, and medium enterprises between May and June 2022. Under the Anchor Borrowers Program, for instance, the bank released the sum of $3.62 billion as disbursements to 12 projects for the cultivation of rice, wheat, and maize, bringing the cumulative disbursements under the program to 1.01 trillion naira to over 4.21 million smallholder farmers cultivating 21 commodities across the country. The bank also disbursed $3.72 billion to finance 3 large-scale agricultural projects under the Commercial Agricultural Credit Scheme. These disbursements bring the cumulative disbursement under this scheme to 744.32 billion naira for 678 projects in agro-production and agro-processing. As part of its efforts to support the manufacturing sector, the CBN disbursed the sum of 113.08 billion naira to 19 new projects under the real sector facility. The funds were utilized for both greenfield and brownfield projects under the COVID-19 intervention for the manufacturing sector and the real sector support facility from differentiated DCRR. Cumulative disbursement under the real sector facility currently stands at 2.183 trillion naira for the financing of 414 real sector projects across the country. Furthermore, under the 100 for 100 policy on production and productivity, the bank has released 9.98 billion naira to 5 projects, bringing the cumulative disbursements under the intervention to 68.13 billion naira to 48 projects, comprising 26 in manufacturing, 17 in agriculture, 3 in healthcare, and 2 in the services sector. Under the healthcare sector, the bank disbursed 4.44 billion naira to 3 healthcare projects under the Healthcare Sector Intervention Facility, bringing cumulative disbursements to the healthcare sector to 133.42 billion for 129 projects comprising 76 hospitals, 32 pharmaceuticals, and 21 other healthcare services. To further expand the nation's non-oil export basket under the Export Facilitation Initiative, the bank released the sum of 36 billion naira for 5 projects in domestic production and value addition of cocoa, sesame seeds towards improving non-oil foreign currency revenues. To improve electricity supply, in order to lower the overall cost of production in the real sector, the bank also intervened in the power sector to facilitate deployment of enabling infrastructure. Summarily, the sum of 2.53 billion naira was disbursed to DISCOs for the operational expenditure OPEX and CAPEX under the Nigeria Electricity Market Stabilization Facility, Phase 2. Cumulative disbursement under the NEMS 2 currently stand at 254.46 billion naira, 6.4 billion naira. Under the National Mass Metering Program, the bank disbursed 47.82 billion naira for the procurement and installation of 865,956 meters across the country. The outlook. The broad outlook for both the global and domestic economies in medium term remain clouded with uncertainties associated with headwinds such as the substantial disruptions to supply chain, the Russia-Ukraine war, and the lingering impact of COVID-19 pandemic. Others include the rising level of corporate and public debt in the advanced economies and emerging market and developing economies, as well as the broad shocks to foreign capital flows driven by the aggressive normalization of monetary policy in some of the advanced economies. On the domestic front, available data on key macroeconomic variables indicate the likelihood of a subdued output growth for the Nigerian economy in 2022. This is hinged on the ongoing and expected shocks from the global economy, particularly from supply blockages of essential exports from both Russia and Ukraine, the impact of high crude oil prices given Nigeria's position as an oil exporter and importer of refined petroleum products, and the aggressive normalization by some advanced economies. Accordingly, the Nigerian economy is forecast to grow in 2022 by 3.3% CBN estimate, 4.2% federal government estimate, and 3.4% IMF estimate. The committee's consideration. Committee assessed the impact of emerging external shocks and legacy issues on price development and the recovery of output growth in the short to medium term. Members further noted the continued effort by both the monetary and fiscal authorities to dampen price pressures and sustain the recovery of output growth. In the opinion of our members, the major external shocks to the economy remained those associated with supply constraints arising from the Russia-Ukraine war and backlash from sanctions imposed on Russia, residual impact of COVID-19 pandemic, and tightening external financial conditions, particularly global financial markets, following the aggressive normalization of monetary policy by some advanced economy central banks. On the domestic scene, members assessed the impact of the continued upsurge in money supply resulting from the increased demand for money associated with election spending and increase in month-on-month inflation between May and June 2022. In addition, the committee assessed the continued impact of rising insecurity, the rising cost of automatic gas oil AGO, and the persistent upward pressure on other energy prices on the general price level. MPC noted that the current upsurge in price levels remain a primary concern to monetary policy, as members focused on the optimal policy approach required to address this development while protecting our fragile economy. The committee clearly identified that inflationary pressure was being driven by both demand and supply side factors, which should be addressed using different policy approaches. In the committee's view, the demand side factors were being broadly addressed by the bank using the relevant direct and indirect instruments. On the supply side, the bank has continued to provide the necessary support through its development finance initiatives in the real sector to ease supply constraints. The committee called on the federal government to prioritize efforts to curb the menace of insecurity to enable farming and other business activities return to normalcy. The MPC thus called on the bank to continue its investments towards increasing food supply in a bid to addressing food inflation. Members also noted the upward price pressure, particularly on transportation, resulting from the prolonged scarcity of premium motor spirit PMS, and called on the federal government to seek a long-term and viable solution to strike a balance between the pricing and supply of PMS in Nigeria. The committee appraised the continued recovery of output growth, noting that despite the obvious external and internal headwinds, the recovery has remained resilient with hopes of a stronger medium-term recovery. This, however, hinged on the continued support by the bank and the federal government to ensure that recent economic gains are indeed sustained. MPC welcomed the bank's concerted efforts towards ensuring exchange rate stability, noting the current difficulties associated with managing the stream of external shocks impacting the economy. The committee applauded the performance of the RT200 and similar initiatives targeted at improving accretion to results and stabilizing the exchange rate. The MPC noted that foreign exchange inflow through the RT200 FX program during the first quarter and the second quarter of 2022 had increased substantially to almost $3 billion as of June 2022. Members also noted the increase in diaspora remittances as a result of the Naira for Dollar incentive and urged the bank not to relent in its efforts to encourage foreign exchange inflow into the country. The committee noted the federal government's increasing debt profile and expressed concerns over debt sustainability given that global uncertainties remain elevated. MPC thus reiterated its call to the federal government to urgently diversify its revenue sources through various initiatives such as the development of a viable tax framework for the extractive and mineral export industries to strengthen its fiscal buffers. Despite the apparent headwinds confronting the economy, the MPC noted that the banking system remained robust given the continued decline in NPLs below the prudential threshold and enjoined the bank to sustain the trend by maintaining its vigorous surveillance to ensure continued resilience of the banking system. The committee's decision. MPC noted with concern the continued aggressive movement in inflation even after the rate hike at its last meeting and expressed its unrelenting resolve to restore price stability while providing the necessary support to strengthen our fragile economy. As regards the decision as to whether to tighten, loosen, or hold, members were unanimous and so did not consider both loosening and retaining rates at existing levels at this meeting. This is because on loosening, the MPC felt loosening will worsen the existing liquidity condition in the economy and further dampen money market rates necessary to stimulate savings and investments. Members also felt that loosening would trigger the weakening of the exchange rate, which could pass through to domestic prices. MPC did not also consider holding rates constant because a hold stance may suggest that the bank is not responding sufficiently to both the global and domestic price developments as inflation numbers continued to trend aggressively upwards. And as regards tightening policy stance, members were unanimous that given the aggressive increase in inflation, coupled with the resultant negative consequences, particularly on purchasing power of the poor as well as retarding growth, there is the need to continue to tighten. However, the policy dilemma was hinged around the level of tightening needed to rein in inflation without dampening manufacturing output, which could result from the higher cost of borrowing. Aside from narrowing the negative real interest rate gap, members were also of the view that tightening would signal a strong determination of the bank to aggressively address its price stability mandate and portray the MPC's sensitivity to the impact of inflation on the vulnerable households and the need to improve their disposable income. Members also noted that the last 150 basis points hike by the committee in May had not permeated enough in the economy to halt the rising trend in inflation, and noted that the month-on-month percentage point increase in headline inflation rose sharply in June 2022 compared with May 2022. MPC also noted that other complementary administrative measures deployed by the bank to address the growth in money supply did not moderate the inflationary trend. Addressing the balance of policy objectives and developments in the global and domestic environment, the committee resolved that the most rational policy option would be to further strengthen its tightening stance in order to effectively curtail the unabated rising trend of inflation. Members were conscious of the fact that output growth remained fragile. However, not containing inflation now could erode the moderate gains achieved in improving consumer purchasing power and thus worsen poverty levels for the vulnerable populace. To ensure that output still remains in focus, MPC advised the bank's management to continue to use its development finance tools to support the agricultural and manufacturing sectors in Nigeria. Committee thus voted unanimously to raise the monetary policy rate, MPR. One member voted to increase the MPR by 150 basis points. 6 members by 100 basis points. 1 member by 75 basis points, and 3 members by 50 basis points. Consequently, committee resolved to increase the MPR by 100 basis points from 13% to 14%. And in summary, MPC voted as follows. 1. Increase MPR to 14% from 13. 2. Retain the asymmetric corridor at plus 100 and minus 700 basis points around the MPR. 3. Retain the CRR at 27.5%. And 4. Retain liquidity ratio at 30%. Thank you for your attention.
Thank you, Governor. That was the committee of the 286th meeting of the Monetary Policy Committee of the Central Bank of Nigeria, holding today, Tuesday, 19th of July, 2022. Now, we will give the of the press a chance to answer a couple of questions. Now, tell us your name, the media house you represent, and then the question.
Thank you. My name is Collins Weze. I write for The Nation. My question is on inflation, which has continued to go. Mr. Governor, the last NBS statistics show that March inflation was 15.92. Then in April it moved to 16.82, and now 18.60. Could you tell us the efforts you need to take to reduce this inflation and to reduce the impact on average Nigerians?
Good afternoon, Mr. Governor. My question is on RT 200. In the last MPC, you mentioned that we had discussed about 2 billion in rebates on non-oil exports. Can you give us an update on that? And also, can you give us an update on the performance for 100 for 100 policy? And also, can we expect more inflows in remittances? Thank you.
What's the name? This day.
Good afternoon. My name is Kola Idowu. I write for Leadership Newspaper. I would like to have an update on the e-Naira. I know it sounded at improving financial inclusion in the country, and I've been told that there will be updates on it. So I would like to know the updates on the e-Naira, how far it has gone, particularly concerning the USSD. Also, I would like to know how much has been, you mentioned that the Naira for dollar has increased remittances. How much has the CBN been able to bring in through the Naira for dollar?
Okay, well, I have two questions from Abuja. This one is coming from Abu Wahab. It's New Telegraph. Is it now that the election period is upon us, what is the CBN doing to ensure that the Naira maintains its value in the face of allegations that politicians are still mopping up dollars to prosecute their campaigns? And the next question is coming from Sunday Michael, Daily Trust. He said, Governor, sir, you have listed a series of interventions that the bank has made, particularly in the agricultural and health sectors of the economy. Many are keen to know the impact of these interventions and the status of repayments by beneficiaries. That's it. Okay, maybe perhaps we'll just take one more question.
I'm Kiru Mokedi. I report for AIT. My question is just on the health sector intervention. Now, at the weekend, major news at the weekend was that the Vice President had a successful surgery in Lagos. And I know that CBN has been talking more about patronizing local industry and then patronizing made in Nigeria. Now with this, how would you really feel about this? That going to hospital in Nigeria instead of traveling abroad. How will this really help impact on medical tourism and conservation of efforts in Nigeria? Are we really expecting more intervention in the health sector? Thank you, sir.
Thank you.
I think that's what we can do. Thank you.
On the question regarding what, the fact that Wednesday says that inflation has been trending very aggressively from March to April and now at 18.6. And what are we doing, or what are we going to be doing to reduce the impact on the ordinary Nigerians? The truth is that, as we all know, inflation can be a terrible scourge. And what that means is that it's capable of totally obliterating the purchasing power of citizens of the country, particularly the weak and the vulnerable and the poor. Inflation, by the time it weakens the purchasing power of the vulnerable, naturally will also lead to heightened unemployment and would ultimately retard growth. Like you've all noticed, globally since the beginning of the year, there has been heightened level of inflation all over the world, to the extent that today we see, even in developed economies, the fact that as a result of even the rising inflation, supply chain problems and the rest of them, even most of those developed economies are already facing a threat of recession. Both the US, the EU, and some other economies suffered massive declines in their output. In the US, it was a negative output in the first quarter, and the fear is that if the United States witnesses a second decline during the second quarter of 2022 in output, naturally it means that the US will also be going into recession. And the expectation, unfortunately, the fear is that this may happen after the second consecutive negative output of the United States. And that is the reason why when we come sometimes to the MPs and say that we have to be very careful about the rate of acceleration in prices or inflation, it is a very serious matter that monetary policy committee members take very seriously, because what you find is that as inflation continues to trend aggressively higher, it would no doubt adversely begin to retard growth in any economy. And that's why, like you may have observed, most of the countries of the world, both the developed and developing economies, have had to embark on very aggressive rate increases so as to dampen the effect on inflation. For instance, this year alone, the US Fed, the FOMC, has increased rates 4 times. It is because inflation in the US in 2020 was 2.5%. As at this time that we speak, the last numbers released, US inflation is 9.1. In the EU, I'm also sure that they have been hiking rates since the beginning of the year, at least by more than 2 or 3 times. Inflation has moved up from about 1.4% in 2020 to 8.6% in 2022. In Brazil, they have increased rates this year 5 times, which is like an average of a monthly increase in interest rates. And their inflation has moved up from 4.2% in 2020 to 11.89% in 2022. In the UK, they moved rates up indeed 4 times this year, because inflation has moved up from 1.8% to 9.1% as at the last time that data was released. Of course, in Egypt, coming to Africa, they have increased their rates 3 times this year, because in 2020 the inflation rate was 7.3% and today is 13.2%. Ghana has increased rates 3 times this year. Inflation had moved up from 7.8% in 2020 to 29, almost 30% today. Whereas in Nigeria, what we have done in our own attempt to pursue a policy of price stability that is conducive to growth, we have tried over the couple of meetings to leave rates the way they are, while at the same time we have been pushing hard on how to improve on output growth. But of course, with the aggressive acceleration of inflation rate in Nigeria, we decided in May, after almost about 2.5 years, to raise rates by 150 basis points. For our own review, if we have to conduct a comparator analysis, in 2020, Nigeria's inflation was 12.13%. Today, the last data released just about a few days ago puts inflation at 18.6%.
And there we have it. It's another hike right here in Nigeria, by another 100 basis points from the previous 150 basis points there. We heard the central bank governor there giving the briefing right here in Lagos. Analysts were expecting at least 50 basis points, but we're getting 100 basis points. So some Others actually saw this coming at the end of the day, because we're seeing, inflation rise even more aggressively at this point, even after the previous hike. Well, joining me now, we have Dr. Muda Yusuf, CEO, CPPE, join us right here in our Lagos studio. And we also have Nnamdi Nwizu, co-managing partner, commercial partners, join us via Zoom today. And we have Chinwe Egwin, Chief Economist, Coronation Merchant Bank, also join us. But I'll start with you, Dr. Muda. So it's another 100 basis points. Are you surprised at this decision?
Well, not too surprised, but I'm concerned about the implication of this. Because when we look at the variables driving inflation in Nigeria, it's possibly not exactly the same with many of these other countries that the CBN, is comparing Nigerian economy with. Of course, the energy situation is a #1 issue. Effect on production, particularly those who rely on diesel for purposes of, generating electricity. Then the impact on transportation, because most of the trucks that move things around in the country, haulage, are powered by diesel. So that's a major factor. The second major factor is the depreciation in the currency, the exchange rate factor. I'm surprised that in the communique, there was no reference to the widening gap between the official rate and the parallel market rate. That's a major issue, which I expect the MPC to also address. But what I heard was, a kind of commendation that things are still stable.
Yeah, with the RC 200.
Yes, it's one of the biggest trouble spots that we have. So I'm not particularly comfortable that that was not addressed. Then, of course, we have the issue of insecurity. That has been with us for some time. And we all know the very serious implication that that is having on food production. Then, of course, there is one factor that the CBN and many government officials are often silent about. Is the degree or the rate at which the CBN is providing overdraft, to the government. We have seen a lot of figures ranging from 15 trillion to almost 19 trillion cumulatively. That, again, is a major issue in inflation. That does not come up, and it rarely comes up in the discussion that we have with government authorities.
Quite interesting.
The only time we have this kind of, the figures come up is when we have budget sessions, like in the last budget presentation analysis that the minister said, over 1 trillion was paid as interest to CBN on ways and means. So where do we stand on all of that? These are the key issues which I think we need to address, because MPR increasing is just going to put additional pressure on manufacturers and investors. Because if you look at domestic credit to private sector as percentage of GDP, it's less than 20% in Nigeria.
And if they do not act, at this point, that's talking about with the interest rate,
yes,
that would also send another signal.
No, this system is not credit driven. It's not credit driven. I'm just giving you a data now. Credit to private sector as percentage of GDP is less than 20%. In South Africa, it's over 100%. In US, that the CBN was, it's over 200%. That shows the significance of private sector credit in the economy and the size of it. So we need to compare like with like.
Quite a lot to unpack there. But let me go to Chinwe Egwin. I don't know if we have Chinwe Egwin right there or via Zoom. Is she there? Hello, Chinwe.
I can hear you.
Yes, Chinwe, I can hear you. Let's have your own perspective on this 100 basis points hike and the impact you think it will have on inflation.
Well, this was somewhat in line with our view. We did expect a rate hike following the uptick that was reported in the inflation figures. I think it's safe to say that there are expectations around GDP coming in at as high as 3% year on year for the Q2 numbers. I think that will be released in August. So this was somewhat in line with our view. We also did consider that there could be a hold stance that is given the committee's popular wait-and-see approach when they make decisions to appraise the impact of the decision that has been made. But on inflation, the governor did mention that issues surrounding inflation are structural. He did mention that inflation figures are, climbing across different economies, advanced and developing economies. So what is the impact on inflation? Let us see what will happen, because the supply side constraints is really cost-push inflation that we're seeing right now. Of course, this monetary policy tool is what central banks use to combat rising inflation. So apart from hiking, there are other elements or other policy actions that are required to help with taming inflation, which are geared towards structural issues, or just closing that infrastructure gap that's super wide in Nigeria.
Quite interesting, but hopefully we'll see some kind of reaction, at the next inflation report we get. But let me come to Nnamdi Wizu, also join us via Zoom. Great to have you, Nnamdi. So let me have your reaction, to this hike at this point.
Well, the hike was expected. If you look at what's happening globally, we've seen central banks across the world continue to raise rates. Fed is expected to raise rates by 75 basis points at their own Fed meeting next week. Some are even anticipating that you might have a 100 basis point hike. So if you are to look at inflation and look at where the correlation should be between our own rate hikes versus what the Fed is doing, then you would even see that 100 basis points might not even be enough at this point in time. However, like Chinwe said, beyond just raising rates, there need to be other actions taken by the central bank if they're trying to rein in inflation. If we consider the fact that OMO rates haven't been moved up by the central bank from the last MPR rate hike till now, signals sort of to the market that we're really not ready to push up this rates, because ideally we know right now in the market that OMO is a much more effective tool than just raising the MPR rates. So as long as you have OMO rates remain where they are, and then you have CRL remain where it is, then it's a bit difficult to have a hike in the MPR to be as effective as you expect it to be.
Right, and what do you see, how do you see the equities market actually reacting to this?
Well, rate hike is always negative for the equities market. As long as the central bank starts to tighten, then you're most probably going to see equities market struggle. We've seen the market struggle a bit since the last MPR hike, and having another one definitely means that you're going to see a bit of sell-off in certain names or certain stock. People are going to be looking at options that they have. So if you're looking at when Treasury bill rates were at 1% versus now where the last auction closed at 7%, and the central bank does tighten, raise their OMO rates, then you start to see that fixed income and other things become a bit more attractive, and you start to see better alternatives, right? And then also for some of the companies, it also increases their cost of funding. So it definitely would have a negative impact on the equities market, and it's the same thing globally.
Right, and it'd be interesting to see how, the market actually closes. They will be watching out for that. But let me come to Dr. Muda now. So it's another hike now. Let's say the next inflation report comes out and we don't see inflation actually tamed or reacting at all to this. What next?
You see, personally, I'm not optimistic that the MPR will have any significant impact on inflation, given the very nature and structure of our economy and given the nature of the key drivers of inflation. At the last MPC meeting, we had a 150 basis point increase. Between then and now, what has happened to inflation? Inflation had gone up further.
Or would it be like some kind of lagged effect? Or maybe...
Not necessarily. It's a question of how effective or how potent these monetary tools are in dealing with inflation.
And we saw the same thing in the U.S. too.
The U.S. economy is not the same thing as the Nigerian economy. Look at the kind of forex crisis we are having. Between then and now, look at the situation with the exchange rate. You know, and that is one of the things that bothers me. If the CBN doesn't reckon with the fact that we are having a major crisis with exchange rate, if the CBN doesn't reckon with the fact that the parallel market rate is now over 600, if the CBN doesn't reckon with the fact that the parallel market is now becoming almost a default market for Forex, then we have an issue. Because we need to address all of these things together. The bigger issues are supply side issues. Of course, the CBN governor mentioned the need for the fiscal authorities to do a few things, but I expected a lot more emphasis on that. And already, prime lending rates, as a result of the last review in the MPR, prime lending rates had gone up to between 18, 19, almost approaching 20. Now with this review, what you are going to see from the banks to the investors that have already borrowed money from them is a review of rates. So how will these investors deal with all of this? You have a hit that they are taking from the FX angle because there is serious challenge of liquidity in FX. You have the issue of the diesel that they are dealing with. Now, on top of that, we are adding additional pressure on interest rates. That is my concern, because these are the entrepreneurs. We are talking about creating jobs. We are talking about increasing output. To the extent that this will not actually moderate inflation, it can only put additional pressure on those who are in production and those who are investors in the economy, the entrepreneurs. This is my concern. So we need to deal with this issue, and the CBN needs to come to terms with the reality of our FX problem. If you talk to any business person today, two key issues: the energy issue, which is the diesel issue, and the FX issue. We are not getting the kind of emphasis that these issues require from the authorities. And that is not good for our economy.
Yeah, the FX issues is quite a big one. And let me bring this to Chinwe right now. So Chinwe, the FX issue is still, the huge elephant in the room at this point. And, we've seen how the US dollar, has gone on a massive run, when the US Fed started hiking rates. And we're hiking rates here, but still we're not seeing the Naira actually strengthen. What do you think we should be doing now and, other emerging economies to actually strengthen currencies?
Well, I'm going to limit my response to the INE or NAFEX window. Right. And of course, there are multiple factors that influence the exchange rate, such as the external reserves level, which is crucial. And we did see a month-on-month uptick with the reserves at, I think, $39.2 billion in June. And of course, as you've said, Naira has depreciated. It depreciated by 1.3% month-on-month on that window to close at 425 Naira per USD at the end of June. What we've also observed is that there have been FX injections from exporters and non-bank corporates increasing, or in June, we saw an increment. I think both of them accounted collectively for about 74% of FX inflow into that window. Now, in a nutshell, or in summary, my response to your question is that FX demand pressure is still outweighing supply, and in coming months, there are expectations that this would persist. We also have to understand that the electioneering period would soon hit its peak. And just based on historical or trend analysis, there's usually increased pressure across windows, including the parallel market, during this period. So small room or expectations of steady depreciation in coming months would not be a far-fetched assumption.
Right, and let me come to Nnamdi now. So what do you think investors should be doing at this point? Because it looks like the MPC right now is ready to go as aggressive, as possible.
Well, so it depends on what type of investor you are, how savvy you are. If you are a market trader, for instance, you most probably see more people looking to go short on some financial assets. You see people looking to exit their equities. Most people want to wait. Either you're waiting, so you're exiting your position, staying on the sidelines to see how aggressive the central bank will be with tightening, or you decide you want to go short so that by the time asset prices fall, be it equities or bonds, then you can come back in to buy at lower prices. We've also seen quite a bit of interest from a lot of clients who are looking to get USD exposure. So you've seen them, looking at or focusing more on assets like Euro bonds or US equities versus local papers. So I guess that is the trend now that we see, and you might see a bit more of that happening. But a lot of people are worried with the way the FX market is going. So this isn't the best of time for most of them to try to lock in. This is the time to try and either stay neutral or look at going short to take advantage of the expected increase in interest rates based on the central bank policy and the central bank direction at this point in time.
And we've seen the equities market, it is the best performer, for the first half of this year compared to other equities market. Do you think it's downhill from here?
Well, I think we'll see the market struggle. We've already seen what has happened since the last MPR hike. We've seen the market has struggled to continue on its upward trajectory since then. And if the central bank does tighten aggressively beyond just raising the MPR, then we'll most likely start to see the market struggle a bit more and possibly see the index start to come down. That will be my expectation.
Okay, well, we'll keep tracking that market, but let me bring it to you now, Dr. Muda. So, you heard the central bank governor. They talked about disbursements to support the manufacturing and agri sector. Quite a good amount of disbursement was seen. Talking about 744.32 billion naira. That went to, I think, the manufacturing sector. How are you seeing all that support at this time?
Well, those supports, I think they are good. They have impacted positively on those who are beneficiaries, even though there are issues around the quality of the intervention, the rate at which the rate of default in some of those interventions, particularly at the much lower level, things like the Anchor Brewers program and so on. Some of the borrowers, see these interventions more or less as what you call national cake, in quotes, But for those in the medium to higher level, I think it has been very impactful because the kind of fund you get through the intervention framework are not the kind of funds you can get from the regular commercial banks. Look at the rate, single digits, and look at the tenor. Tenors as high as 5 years, 7 years, and so on and so forth. So these are not things that you can easily get within the conventional banking system. So to that extent, I think the interventions are good. But it is very important that we have a framework that allows for investment to flow in naturally outside of these interventions. Because the flow of investment, either from within the country or from outside the country, either from portfolio flows or from FDI, are also very critical.
We need the flow even more than
but the FX situation is not allowing that to happen. That is my concern.
All right. Well, we're still analyzing the post-MPC meeting, and we've had with us Dr. Muda Yusuf, CEO CPPE, Nnamdi Nwizu, co-managing partner, Commercial Partners, and Chinwe Egwin, chief economist at Coronation Merchant Bank. They're still here with us. We're going to take a moment now. We'll be back. Do stay with us. All right, we're still discussing post-MPC decision right here, and we saw that the MPC actually raised rates by another 100 basis points due to the surging inflation we're still seeing in Nigeria. And I still have in the studio Dr. Muda Yusuf. I also have Mr. Nnamdi Nwizu, co-managing partner, Commercial Partners, and Chinwe Egwin, chief economist, Coronation Merchant Bank, still here with us. Let me head on to Chinwe. right now. So, Chiwe, let's look at the impact of the last hike on bond yields. How are you seeing it?
I think one thing to highlight is that the average FGN bond yields have trended upwards. And this is because there was an upward adjustment, as you mentioned. And this was seen at the longer end of the curve following the hike in the MPR to 13%. But we did notice that the effects faded slightly. However, in recent weeks, yields have trended upwards. So it'll be interesting to see how that market responds to this 100 basis points hike.
Right, and let me come to Dr. Muda now. So, Dr. Muda, the governor did mention the concern about the uptick in non-performing loan ratio. You heard that he was quite vocal about that.
Yes, I think it's a reflection of the challenges in the environment. Because more and more businesses are finding it difficult to cope with the barrage of headwinds from FX, from energy costs, from insecurity, from logistics, and so on and so forth. I think it's a reflection of that, because once you have too much of these headwinds, the capacity to be able to repay loans will be constrained. And that is what is playing up. And that is why I'm worried about some of these policy development and responses. Because we have two major categories of investors when we talk about these issues of this nature. You have those who are in the financial markets. They move financial instruments, and their instruments are very flexible. They can move easily from the bond market to the treasury bill market to equities and so on and so forth. It's not the same thing when you are talking about entrepreneurs. Somebody who has put a factory in place, you can't just switch from producing maybe a biro to producing chocolate. You are stuck with it. And this group of investors are playing a very critical role when you talk about job creation, when you talk about developing value chains, when you talk about pushing exports, when you talk about building an economy that is inclusive. So it is very important that we are sensitive to what is happening to this group of investors. That's not to diminish the importance of those who are investing in financial instruments. But when it comes to deepening what an economy should be and bringing as many people on board as possible, we should be relating to what their concerns are. Because the investment climate issues are very important issues. And some of these things we cannot fix very easily. What we can fix very easily are some of these policy responses.
Right.
To make sure that we mitigate the challenges that these entrepreneurs and investors are facing.
Okay.
Because it's becoming increasingly unbearable.
Right.
By tomorrow now, the banks will be serving new notes to investors who are owing their money. They are going to be reviewing rates, irrespective of what challenges they are facing. That is the concern that I have.
Yeah,
and that is the concern that most of the people in the real economy, that is the concern that they have.
Right, and the real economy actually need all those monies actually coming in, at this point. But let's head on now to the CBI. I heard the governor is talking about education, tourism, but let's hear what he's talking about right now. I know they're having that question and answer session right there. All right, let's listen to the next question.
All of you for being here. I wish you a safe trip back to various destinations. Thank you and God bless. Thank you.
Okay, I guess we missed that answer there. It's done now. Everyone's leaving right there. So, Dr. Muda, it's official. it's a new hike, and obviously the economy and most central bankers now are torn, at this point. How do you tackle inflation without, putting the economy at risk? But it seems that the central bankers have no choice in this matter.
You see, the thing is that we have practically exhausted the monetary policy tools as far as this inflation is concerned, taking into account all these critical variables. At this point, we expect some intervention from the fiscal authorities. Not just so much by spending money, because we know the government doesn't have the money to spend, but about trade policy, for instance. What are we doing about import duty? What are we doing about tariff policy? I mean, we say that the investors, manufacturers, all of them are having issues. We can begin to review some of the import duty on their intermediate products, on their inputs. We can begin to review that. That could go a long way. Because if you look at customs revenue as a percentage of total government revenue, I don't think it's more than 10%. But if you know the pressure and the kind of burden that all this customs revenue import duty put on those who are in production, you'll be amazed. It's a lot of pressure. So the fiscal authority should not just sit by. It's not only about just revenue and tax. It's also about manipulating some of these tariff policies. We should have an engagement with the manufacturers, for instance. We should have an engagement with even service providers. I mean, we just had the celebration of this hospital that did the surgery for the vice president.
Exactly, it's quite laudable.
What kind of fiscal policy are we putting in place to support the hospitals, for instance? Are we waiving the cost, the import duty on their equipment and all of that? Are we giving them any tax concession so that you can put a stop to all this medical tourism and so on and so forth? So the point I'm making is that
education tourism.
Education tourism. What are we doing to support investors in education? These are social sector investments. So we should do a lot deploying fiscal policies in the area of tariff concession, in the area of tax concession to selected players in the economy, without necessarily hurting those who are in domestic production.
Right.
So all right, these are some of the things I think
let me bring in Nnamdi Wizu now. Nnamdi, if you can hear me. So we're talking about the options, available now to our central bankers. What, in your view, do we have, does the central bank have to tinker with, at this point?
Well, I think the central bank is already doing what it can, which the focus of the central bank would be the monetary policy, right? We've talked about raising the rates. I mean, you can look at currency and find out if there's a way they can loosen their currency policy to allow Naira to value a bit. Because if you look at the spread between the power market and the central bank official rate, you're looking at almost a 40% or 50% spread. So that's one thing they can look at. However, we still know that the major issue that we have here is really more supply side. Even with regards to the currency, it still comes down to supply side with regards to currency. So even if the central bank were to devalue the currency today, yes, that would hopefully bring in a bit of inflows, from offshore people who believe that Naira is currently overvalued. But you still come back, route to the same thing, which is that we still don't have enough supply of FX. We know what's happening with regards to crude oil production at 1.1 million barrels per day versus a peak of about 2.1 million. When you factor that in, you're losing almost 50% of your FX proceeds, right? We still know what's happening with regards to things like fuel subsidy and all, things that are more on the fiscal side rather than the monetary policy side. So there's a limit to what the monetary policy can do. There's a limit to how much you can use monetary policy to fight, the ills or correct the ills in the economy. what they can do, like I said, is looking at things like interest rates and trying to tinker with the currency. But it doesn't solve the problem. If you don't get the fiscal side of things correct, then you're going to continue to struggle with your monetary policy. Even if you were to raise rates today to, say, 20%, it doesn't necessarily guarantee you inflows coming into the country, because people who come in would still struggle to go out because you have issues on the currency side. So I think that the central bank, it's pushing, I think they're trying their best. Yes, there's still quite a bit of leeway for them to exercise or use other things, but we need to get the fiscal side on board to also help ease the pains in the economy at this point in time.
Right, and a study I recently read talked about a better option being cutting money supply, in the economy, and also reducing rates. How do you think that can actually work? Hello, Namdi, can you hear me? Okay. Okay.
I didn't get the question. Can you repeat that?
Okay, so
I didn't get the question. Can you repeat that?
Okay, so I was talking about a study that I recently read about. It talked about how money supply, in the economy also, exacerbates inflation. They talked about reducing money supply and, reducing interest rates. What do you think about that?
Well, I mean, definitely the money supply has a big issue on inflation, because inflation typically is either you have demand pull or supply push, right? So it depends on which side. If you're looking at it from demand pull type inflation, then money supply definitely has a big role to play. You continue to see too much money chasing too few goods, right? But we know that what we're seeing now is a bit from, you have the cost side, right? So you have the cost push inflation right now, which is what is pushing inflation, or creating inflationary issues. You've seen what's happening with Ukraine. We've seen how the war in Ukraine has led to all sorts of increases in both crude oil prices, food prices, wheat prices, and all of that feeds into our inflation down here. So we are basically focusing, or we're basically facing two issues. One would be from the cost side, and the other would be from the demand side. Now, money supply would affect the demand side, but doesn't necessarily solve your issue on the cost side of things. So 100% reducing money supply would help you fight inflation from a demand perspective, but not necessarily help you from a cost perspective. In fact, from a cost perspective, it might worsen things, which is why you heard the central bank talking about a balance, because the less you reduce, the less money you have in supply, then the higher the cost of funding, which invariably ends up pushing up cost of production again, which ends up affecting inflation once again. So it's trying to strike a fine balance between your money supply and your demand and cost side of the economy.
All right. Thank you so much for that, Namdi. Well, I'm getting information that we have Ini, because Ini is right there, at the central bank headquarters there. Hello, Ini. Do we have you there now?
Yes, Laddie, I can hear you. We're here.
Great to see you on that side. What else are you hearing?
To be on this side, Laddie.
Exactly.
I do know that one of the things you're discussing there is the issue of money supply, which is a consideration of the MPC reaching this 100 basis point increase in interest rate. Because as you know, and we've been talking about, Laddie, for over some time now, the issue of electioneering and the political activities has also brought in some money supply into the economy. And of course, that is also fueling inflation. So as the central bank governor said, according to the MPC, as long as we see a surge in inflation as is going on, not just in Nigeria, but in the world, then you can expect the MPC to keep increasing interest rate, because that is the one way of dealing with it. And it's interesting that the MPC has also taken into consideration, because, I mean, we've been having conversation of what is the assurance that increasing interest rate will actually deal with inflation and not cause a stagflation in the economy? But the MPC has said that it's also taking into cognizance the fact that the CBN is working on developmental financing, and that should be able to balance it. So with the money supply from the political scene and falling inflation, we do hope that this increase in interest rate would, of course, see at least a tapering of inflation and a balancing with the development financing by the CBN in the economy, Ladi.
Yeah, quite interesting, because right now the battle is against inflation globally. But I know there was the question and answer session. I'm sure we missed, some maybe interesting questions. Did anyone strike you there?
Yes, there were some interesting conversations, but you need to watch the report for that. But I'll give you just a little bit of a hint. The central bank did give a very stern warning to individuals who intend to transact in illegal banking transactions in the country, and he did say that you will be found and you will not be able to transact in any bank in Nigeria. So that is a stern warning that comes from this MPC. That's when he was talking about the e-Naira and the efforts of the CBN, to ensure that more people get engaged in using the e-Naira and the advantages of it. He used that opportunity to warn Nigerians and non-Nigerians who intend or who are already transacting illegally in some banking transactions. And I think, Ladi, one of the areas of your interest, crypto, is
exactly
off the banking transactions. So you watch out for that.
I'll be watching out for that,
Ladi, but the CBN governor is very serious, and he sent out that stern warning. We'll put all that together and we'll have a more comprehensive report on that later on the news on Channels Television, Ladi.
Yeah, because I remember at the retreat, he talked about, fintechs, digital finance, and cryptocurrencies. They're going to be, coming up with a lot of regulation regarding, those types of finance. But anyway, I hope you get a picture, maybe sitting on that seat at some point. But I'll see you later in the office.
I think I'll try and sit. I'll try and sit on the CBN's governor's chair and post that picture.
Exactly, that'd be nice. Thank you so much,
Ladi.
Thank you.
Yeah.
All right, now. So let's bring the conversation back to the studio. Dr. Buddha, you heard her there. Stern warnings. They will be found, those that are using the banks for illegal transactions. What do you think about that warning?
Yes, it is good to welcome innovation in the tech space and all of that.
Right.
It's also very important that we are very careful so that people don't use those platforms, to perpetrate all sorts of issues of money laundering and all of that. Only yesterday I was listening to the news that some Nigerians abroad and
some
all
big
of that.
brand, I saw that too.
Yeah. I've been convicted and are going to jail in the United States. So it is good to innovate. It is good to move, very fast along this tech corridor.
Right.
But it's also very important to be careful so that we don't, in the process of innovation, now leave room for people to perpetrate illegalities. I think that is what the CBN governor was
because I know most of these other forms of assets, like talking about cryptocurrency and fintech, most of them talk about, decentralization, trying to, let the forces, no middleman, reducing cost of transactions and all of that. But all of that also poses risk,
They pose a lot of risk.
A lot of financial system of Nigeria.
It increases vulnerability of the financial system when it comes to issues of transparency, money laundering, and all of that. So that is why it is important that the regulatory framework needs to be a lot more tighter, to avoid this kind of issues.
All right, let me talk to Nnamdi Nwizu right there. Thank you for staying on, Nnamdi. So it's the second half now of the year. What do you think investor sentiment would look like? Do you think the investors would just ignore, inflation, rising inflation, and also the rate hikes, the risk of recession?
I think investors will be concerned. We've had the talk around possibly getting into another global recession. at least recession in the U.S. And we know that recession in the U.S. tends to lead to global recession because, I mean, the U.S. has a major role to play in the economy. So I know a lot of investors currently are very concerned around how things are playing out and worried, what happens. It's almost like a bit of a vicious cycle. So you go into a recession, the Fed raises increased spending to try and, liquidity injection to spend its way out of recession, which leads to extremely high inflation, and then they start to tighten, which leads back to recession all over again. So it's been a bit of a vicious cycle over the last 3-4 years, and it's definitely playing on everybody's minds. And in Nigeria, beyond just a recession, I think we know that one of the major issues people still face here would be security, right? So we know that, for instance, the central bank is trying to push agriculture and the government as a whole, but we know that a lot of people are struggling with herdsmen clash with farmers and co. Insecurity. We have quite a number of people who are relocating from the country due to insecurity crisis and co. And all of that plays on the minds of investors, both the local investors and the foreign investors who would like to come in, because when they look at the economy as a whole.
All right, I guess Nnamdi got frozen there. We'll try and see if we'll get Nnamdi back. But Dr. Muda,
for them.
Okay, you can finish your thought. Can you hear me? Hello, Nnamdi, can you hear me? Okay, well, I think we're having issues there. So, Dr. Muda, so at this time, we're seeing a lot of investors right now, still invested, in these markets. And, hearing what Nnamdi said now, there are risks, right now, with most of these markets. Do you think those that are still invested should stay invested, or should they start, getting out at this point? Is there anything?
Well, even getting out is not easy.
That's another issue.
You see? So, and that is why it is important to create the environment. Apart from all these issues, NPR and the rest of them, we need to create the environment that will inspire the confidence of investors. Because you cannot grow an economy without investors, be they domestic or foreign. And the thing about investment is that, don't say that I'm overflogging this FX issue. The foreign exchange regime is at the heart of investment. It's at the heart of international trade. Whether you are talking of exports, imports, or even the movement of capital in and out of a country. And these things are very critical to how you can progress or prosper an economy. So that is why it is important that we get it right.
Exactly.
We get it right with our forex regime.
This is the time to actually get it right.
We have to get it right.
At the end of the day, emerging economies are at risk,
exactly.
At this point from global shocks. Well, I want to thank you, Dr. Muda Isu, CEO, CPPE. And I also want to thank Nnamdi Nwizu, co-managing partner, Commercial Partners, and Chinwe Egwin, Chief Economist, Coronation Merchant Bank, for staying with us and getting this decision, that most of us were expecting. It is a more hawkish stance, at this point. Hopefully, inflation will taper and react to most of these rate hikes we're seeing. All right, that's the show today. Thank you so much for watching. Hope you enjoyed, watching that decision there from the MPC. Until next time, I'm Ladi Williams. Thank you for watching.